My view of the 60-70 range is gone. I no longer have that view. I now think you could go to 100 to 200 in the next couple quarters. We think over the following 2 quarters or so, in other words, 6 months or so, silver could go to at least 100, more likely 150 to 200. In other words, you could quadruple its price in a matter of a couple quarters, doing the same thing that's been done in many other markets over the past 50 years, here, there, so forth. And the technicals justify assuming that. It's not just gut feel.
In a stunning reversal that has caught the attention of analysts across the metals market, Michael Oliver, the veteran technical analyst with over 5 decades of experience dissecting market momentum, has just revised his entire outlook for silver. Known for his precision and for calling major inflection points in commodities and equities alike, Oliver now believes silver could soar to between $100 and $200 per ounce within the next 2 quarters. This is not a long-term projection stretched across years. It's a short, violent move that he believes could unfold within 6 months. After decades of trading within what he calls an old reality, silver, in his view, is now primed to break that range decisively and rewrite its valuation against every other asset class. For Oliver, this isn't just speculation or emotion. It's a technically grounded analysis based on structural breakouts that have already played out across multiple commodities over the past half-century. Copper, lead, and even gold itself have all gone through similar phases. Decades of stagnation, followed by explosive repricing that left previous resistance levels irrelevant. In his latest analysis, Oliver points to that same pattern emerging in silver, arguing that markets that remain undervalued for too long eventually correct not gradually, but violently. The charts, he says, justify assuming that silver's decades-long suppression is on the verge of being unwound, and the next phase will be unlike anything investors have seen since the 1970s or 2011. To understand the weight of this call, it's important to recall who's making it. Michael Oliver isn't a retail YouTube pundit chasing views. He's the founder of Momentum Structural Analysis, an independent research firm trusted by hedge funds, sovereign investors, and institutional traders for its technical rigor. His momentum-based studies predicted the 2011 gold peak, the 2020 COVID recovery rally, and multiple turning points in equities and energy. When Oliver changes his range for silver from $60 to $70 to a projection that's more than double or triple that, seasoned investors pay attention. His methodology isn't narrative-driven, it's data-driven, built on comparative momentum metrics that have consistently flagged major transitions before the mainstream even noticed. So, what exactly does this mean for silver investors today? According to Oliver, it's not just about higher prices. It's about a complete shift in reality for the metal that's been artificially contained for decades. Silver, he says, is about to behave the way copper did in 2005, when it quadrupled in a matter of quarters and never looked back. In this video, we'll examine the reasoning behind Oliver's bold new forecast, explore how it ties into the broader behavior of the gold market, and discuss what signals investors should be watching next. If you find this kind of detailed market analysis valuable, make sure to subscribe and turn on notifications. We'll be covering every major update as this next leg in the precious metals cycle unfolds. We appreciate the support and hope you enjoy the video.
My view of the 60-70 range is gone. I no longer have that view. I now think you could go to 100 to 200 in the next couple quarters. We've done a lot of technical rationale for that. It's not just a gut feeling, okay? But we've shown that if you look at silver on a chart, just an arithmetic chart, go back to 1975 when gold was legalized. Gold has had huge surge up, then a pullback and a range for a decade. Then another huge surge up and a new higher range for a decade plus. And now is into another surge, which is, by the way, only half as strong so far, measured logarithmic scale, ratio scale, to the prior 2 bull markets. If gold matched them, it'd be $8,500. Okay, but how come silver is stuck in this box for 50 years? We showed charts of copper and lead, okay, real exciting stuff, lead, But in the 70s, 80s, 90s, and into 2000, they were stuck in a range, sort of like silver is now still stuck in. And in 2005 and 6, copper quadrupled in about a couple quarters. It just left that old reality behind. And then over the subsequent decades, a new range that if you divide the middle of that range it's been living in for the last 15 years or so, it's 4 times what it was between 1970 and 2005. Okay. How come silver's still stuck in that range? Then we look at lead, and lead had the same situation for multiple decades, caught it at a price range, blew out of it in 2007, not in sync with copper on its own stuff, quadrupled in price in a matter of a couple quarters, and then lived in a new reality, way above that old reality. How come silver's here? Well, there's some arguments that are likely valid that it's been artificially depressed, suppressed, etc. But whatever the reason, you can't fake reality forever. And if gold, the other monetary metal, has gone from a peak in 1975 at 200, then in 1980 was 850, and now we're 4,000, and yet silver in 1980 was 50, and we're at 48. Okay, now something's wrong there. Forget any intricacies of special situations. What's going on? I mean, lead's 4 times its price then. Copper is silver, anyway, there's a point to be made there. Sometimes markets make mistakes. We know that. As an investor, if you're around long enough, you've seen bubble markets make a peak. And when it falls apart, you look back and say, oh, golly, now I can see why. It was irrational, too high for too long. Even if the concept underlying it was valid, it just went too far too long. And the same thing goes on the downside. Markets make mistakes on the downside. They get down too low. They lay there. Nobody likes them. They're not doing anything good. So who's going to invest in them? And then when they wake up in a thunderbolt. The technicals of silver right now argue to us. Now we've got one trigger level that we'll talk about in a minute. That when it's triggered, we think over the following 2 quarters or so, in other words, 6 months or so, silver could go to at least 100. More likely to 150 to 200. In other words, you could quadruple its price in a matter of a couple quarters, doing the same thing that's been done in many other markets over the past 50 years, here, there, so forth. And the technicals justify assuming that. It's not just gut feel, okay? And anyway, yeah, that's what we see. So the 60, 70, forget it. No, we don't believe that. Much higher. My own personal investments, which I have to disclaim at the end of all our reports, is what do I own? Okay. I'm wholly emphasizing silver and silver related. And I think some of the miners might be as much bang for the buck, if not a lot more, than what silver might do. And the reason is they're still very lagged to the gold miners historically. They're very lagged to almost any way you want to measure to gold. Or the silver miners are the real dogs. The gold miners have gone up, and notice GDX, for example, had a high in 2011 in the 60s. Well, it went up to $80. Okay, pullback, and right now we're like 68 or 70. I mean, we're 70 area. Okay, so it had a pullback, but it burst through this at like a doubling in price in a matter of a handful of months, just to get above the 2011 high, which, as we know, gold's way above that. It was $1,920. Okay, so the gold miner said, I'm here too. I'm back. Okay. The silver miners aren't above that high. For SIL, for example, that high in 2011 was at 90. And we didn't get there. I think we're going to get there and then some. I think it's, again, sort of the phenomenon. I'm talking about what I think silver is going to do technically. The silver miners perhaps should best be viewed not as miner by miner by miner analysis, but more as, hey, they got the stuff underground and it's not priced at even the per ounce level. Okay, you're in effect buying silver bullion at 10 cents on the dollar, okay, by buying the mines. And I think that acknowledgement will come when silver runs its tantrum move. It goes to the new reality. And I think at that point, you want to be long silver. Perhaps if you want to, silver calls that go out a year, let's say, and the silver miners, as opposed to gold and the gold miners, which will also be going up, but less so. So I think it's the focus now should be on the silver component of the monetary metals.
Oliver's first argument rests on the undeniable asymmetry between silver and every other major industrial or monetary metal. While gold has surged from $200 in 1975 to over $4,000 today, silver remains trapped near its 1980 highs, barely touching $48 even during the 2011 bull cycle. Copper, lead, and even nickel have all broken their historical ranges multiple times, establishing new price plateaus that reflected monetary debasement and structural demand. Silver, despite being central to industrial manufacturing, solar energy, and battery technology, has lagged, a market mistake, Oliver calls it, that is overdue for correction. When markets remain suppressed for too long, history shows the eventual adjustment isn't incremental, it's exponential. As we transition into his discussion of gold, it's worth putting the recent price action into perspective. After reaching nearly $4,300, gold corrected modestly to just under $4,000, a move Oliver dismisses as nothing more than a buying opportunity. The longer-term charts, he argues, suggest that gold is still in the early stages of a new secular uptrend, one comparable in scale to the eightfold surges that followed the 1976 and 2001 lows. In fact, his data shows that gold's performance relative to the S&P 500 is on the verge of breaking out from an 11-year base, signaling a broader shift in asset allocation away from equities and back into real assets.
I think the pullback you just saw is a buying opportunity. Again, when you put it in perspective of what has gold done since the government legalized it. Well, it had a bear market low in 1976 after hitting 200, and when it was legalized, it dropped to $103, mid-76. Between mid-76 and 1980, 3.5 years, it went up eightfold. And the conditions that drove that, we argue, are far less dynamic than the ones we're sitting on right now. Okay, 2. The next bull market started in 2001 from a $260 low and went to 1920. Eightfold move. Spanned 10 years, but an eightfold move. Okay, we're only fourfold off the bear low, $1,050 in 2015. So people say, it's overdone, it's overdone. There's another argument that it's just beginning. And it's the first charts I sent you. The first chart shows a spread relationship between an ounce of gold and the price of the S&P 500. And it goes back to 2013. Remember, gold peaked at 11. In 2011, 12, 13 especially, it's entered a bear market, which didn't bottom until 2015, end of that year. During that time, it was underperforming the S&P 500. The spread was collapsing along with the net price of gold. But then, in the 11 years since that, during an 11-year period of that basing process, there have been 4 rally highs in the spread, meaning gold has had a rally versus the S&P relative performance-wise. And each of those rallies, by the way, was actually strong upside in gold, net price. But there's a clear base that a kid with a crayon could draw a line across. 4 separate peaks that are almost flat. You're pushing at that line now, again. Right now, the spread between gold and the S&P is 58.6%. Ounce of gold, D's gold, using D's front month future, S&P. If you ever close a month at 60%, and we were intra-month above that last month. You ever close a month out at 60% on that spread breaks out of an 11-year relative performance base. It says, I'm just beginning. Again, when the spread moves up, net price of gold's moving up. So that chart says, as an asset class choice, stock market or gold, it'll break out versus the S&P in saying it's just beginning. And then it's not broken out yet versus the S&P. But we also ran the spread of gold versus the New York Composite Index, which doesn't have a front end weighting of 5 stocks that constitute 30% of the overall index, like S&P, or 5 stocks in the NASDAQ 100 that constitute 50% of that index. Okay, I measured it against the New York Composite and the Dow 30, same time span, 2013 to present. They've broken out. Already gold is broken out versus those two unfront end loaded indexes. of the U.S. stock market. The only thing that's kept it from breaking out against the S&P is, again, handful of those front-end stocks. That's it. That's the only thing. It's the broad market really has been gold's broken out. It says the game has just begun. I'm now a better place to be than the stock market. The one thing I forgot to talk about was the silver-gold relationship.
Okay.
I argued that silver is going to explode, but you can maintain a spread chart where you divide an ounce of silver into an ounce of gold, express it as a percent. A lot of people do it the other way. It's a ratio chart, but we do it ounce of silver into gold. And right now, silver price is about 1.2% of the price of gold. If you go back and examine what happened in those two prior bull markets at the phase where silver went ballistic, it had been going up for a couple of years, 75, 76, 77, 78, 80 finally. In the last 6 months of that move, silver went quadrupled in price. It had already been in a bull. It wasn't like it wasn't a bull then. It just said, I'm gone. Okay. And in 2010, September of 2010, 6 months before silver reached 50 again, in April 2011, it doubled in half in 6 months. Okay. You want to quadruple silver from where it is now, you're talking 200. Okay. You want to double in half, well, you're talking, 125, whatever. Okay. What was a signal back then that event was going to occur? Because when you looked at the price charts, they were already going up. So it wasn't a big deal that they just went up faster. Okay. So the price charts weren't telling you. You'd already been in a bull trend. The spread. Divide the ounce of silver into an ounce of gold and plot it month to month. And sure enough, back then, even while silver had been going up for a couple of years along with gold, 76, 77, 78, 79, okay, it was going up less. And therefore the spread was deteriorating. Silver was underperforming the advance in gold, so it looked negative on a spread chart. It was still making money, but it wasn't as much as gold. The spread built a structure. And it ran up to a level, pulled back, ran up to another level a year later, pulled back. And when it came through that level, the spread broke out. And that told you silver's now going to beat gold. That's what set off the fuse. Same thing happened in 2010. You'd had a depressed action by silver to gold. It built a spread dynamic that you could see, draw a ruler across it. And in September 2010, you broke out, and that's when the price of silver went ape. We have a very similar situation on the chart I sent you. There's two charts there. One is the spread chart at the top, and you can see there's a red horizontal line on it. Comes to just above 1.3%. Again, we're right now at 1.2%. You ever get a monthly close above 1.31%? Actually, it's where those precise two prior highs were going back 4 years. That breaks out and it says, I'm out of here. And you're still at very cheap historic values of silver to gold. Heck, 20 of the past 50 years, silver's at least been 2% price of gold. Well, heck, if you go from 1.2 to 2, that's a huge multiple. I mean, silver's almost doubling in value to gold. And in bull markets, going back 50 years, during the 79-80 move and the 2010-11 surge, silver reached well over 3%. So from 1.2 to 3, well, wow. Okay. Huge potential multiple. The key is to break that spread out. Now, the chart below the spread, pardon me for getting scientific here, is a momentum of the spread, where we measure the spread in relation, oscillated versus its 10-month average. And you should have the same picture. Dual highs. You want to break through them. Well, heck, in September, we closed on the line and backed up ever so slightly into October. It will take a hair's breadth to break out the momentum above its ceiling. And when it does, you can bet that the spread will follow. So those are the metrics we're watching that tell us the clock has begun. The clock for the go into a new reality.
Oliver's conclusion for both metals, and especially silver, is exceptionally bullish. He points to a specific technical metric, the silver to gold spread, which currently sits around 1.2%. In past cycles, including the 1979 to 1980 and 2010 to 2011 blow-offs, this spread acted as the early warning system for silver's parabolic moves. Each time silver began outperforming gold on a relative basis, the spread broke out of its multi-year ceiling, triggering the kind of rallies that multiplied prices by 4 in a matter of months. The current setup, he notes, mirrors those exact conditions, with silver just a fraction away from the critical 1.31% threshold that historically marks the start of those explosive phases. The historical precedent is clear. In 1980, silver reached over 3% of gold's price. In 2011, it peaked around the same level. Today, it's less than half that. Even a modest return to 2% would imply a near doubling of silver relative to gold. And if history repeats, the move could be far larger. This isn't merely a technical curiosity. It's an indication that silver's revaluation could also redefine the structure of the broader monetary metals complex. Gold's advance may continue steadily, but silver's performance, Oliver argues, will be the real story, the asymmetric trade of the decade. From a macroeconomic perspective, this outlook aligns with several developing themes in global markets. The Federal Reserve's ongoing struggle to rein in inflation while supporting fiscal deficits has created a scenario where real rates remain negative in practical terms, even if nominal yields rise. Meanwhile, China and BRICS nations continue to build reserves of gold and silver while dumping U.S. treasuries, further eroding Western paper confidence. At the same time, the surge in industrial demand for silver, particularly in solar, EV, and AI infrastructure, has made physical shortages a real possibility. All of this compounds Oliver's thesis. The technical breakout isn't happening in isolation. It's converging with a fundamental and geopolitical storm. For investors, the implications are profound. Oliver's analysis suggests that the next 6 months could represent a generational opportunity to position ahead of a structural repricing of both silver and silver miners. He argues that silver equities remain the most undervalued segment in the entire commodities market, effectively bullion at 10 cents on the dollar. When silver breaks out, the leverage in those mining stocks could outperform even the metal itself. Gold will move higher too, but Oliver's conviction is clear. The focus now should be on silver and its miners. If this scenario plays out, we're not simply witnessing another rally. We're witnessing the end of a half-century distortion in the silver market. The technical signals, the spread dynamics, and the historical parallels all point to the same conclusion. Silver's thunderbolt phase is near. As Oliver put it, you can't fake reality forever. Thank you for watching. If you found this analysis valuable, please like, share, and subscribe to the channel. Let me know your thoughts below. Do you believe silver can reach $200 within 2 quarters? Or will it face another round of suppression before the breakout? Your insights and discussions drive this community forward, and I'll see you in the next episode.